Welcome back, everyone. It is time now for Talking Numbers. And, we're talking about how September is historically such a tough month for the market. We want to know why September this year might be very different. And joining us right now to help explain, let me get to that in a moment. Let me actually talk you through just exactly how bad it has been. Investors just suffered through a rough August, the worst in 9 years. The Dow lost 4.3%. The Nasdaq gave up 6.24%. And the S&P 500 down 4.74%. But today's Quant Jock says it could be a September to remember. How do you like that? From extremely bearish sentiment to low volumes and yields, a perfect storm is brewing that could bring extreme volatility and higher markets for both commodities and stock. Richard Ross is at the global technical. He is the global technical strategist at RBAC Grayson. Welcome to you, Richard. Thanks for being on the program. You say that the markets are going to be very, very volatile in September. Explain to us what your thesis is behind that.
Sure. We believe that today's explosive advance is simply the beginning of an incendiary surge in risky assets, and prices are poised to move significantly higher.
Technical look here at a few of the individual markets, starting with silver. You see a bullish flag formation here. Explain why.
Sure. Silver, gold steals a lot of the headlines, but we think that silver, the second place metal, is actually in a very strong technical position, breaking out from over a 5-month high this week. We think that set the stage for a test of $20. We're looking for a breakout above $20 to provide the catalyst for a test of the 2008 high around $21.35. We're bullish on silver.
You said that gold steals the headlines, so let me ask you, what about gold in this particular case?
Sure. Well, we've liked gold, and we continue to like gold. We think it makes an attractive investment even at these levels after a fantastic run. Throughout all of this volatility in the global markets, gold has excelled as a two-way star, as both a currency of fear and a proxy for risk. We now have a blue-chip roster of hedge fund investors lining up behind gold. We have retail buyers, foreign central banks. We think the case for gold is strong and intact. We see higher prices ahead.
A lot of people, though, have said maybe gold is a bubble. I mean, you look at the fact that you've got a Harrods in London now issuing gold bars. You can buy a gold bar there at Harrods. You've got ATM machines in the Middle East that will dispense gold bars. Some say it's a bit of a top. What's your take on that? Not the case?
Well, we think that's a fair criticism after a decade where we've seen gold rise almost 400%. We think that criticism is fair but unwarranted. We think the case for higher gold prices is intact, and history has shown that human beings have a very poor track record of predicting bubbles, as you well know.
Let's talk a little emerging markets here. You're very bullish on India. Explain your thesis on that one.
Sure. We think that India is in one of the strongest technical and fundamental positions of the major emerging markets that we follow. The benchmark Nifty index is up over 5% for the year, a very bullish divergence in a market of uncertainty in the sea of volatility. The Nifty index broke out above 5,400, which completed a 76.4% retracement of the entire decline. In conjunction with the absence of overhead resistance, we feel like the Nifty is poised to potentially retest that 2008 high around 6,350. That would generate a return from current levels around 16%, which in this market is pretty attractive in my opinion.
So, Richard, what's the bottom line here for investors? Are you telling everyone to go out and buy?
In a word, yes. But let me be a little bit more eloquent here. I think investors should conquer their fears. They should embrace risk. They should break free of this uncertainty and malaise engendered by the torrent of negative headlines and black swan predictions. We feel you should overweight equities, gain exposure to emerging markets, gain exposure to commodities, reduce your exposure to low-yielding bonds. We think the time is now. You can buy now or chase later.
Well, I've got to say, that was very eloquent. Richard Ross, thank you very much. We appreciate it.